Okay, so chapter 1 is an introduction to managerial finance. What we're trying to do in this class is get you to think like a financial manager that's working in a firm. So, to be a good financial manager, you have to start thinking in certain ways. And one of the main ways to think is about how money um, changes in value over time. And we like to assert this change in value to a level of interest. I'm sure you've heard of compound interest over the years, and it's a mechanism to be able to say, if I'm going to take a certain amount of time to get my money back, I want a certain amount of interest on top of that. So I'll get more in the end than I gave in the beginning. So that's kind of the thought process that you should try to stick to when you're thinking of trying to solve some problems that we're going to get into here in a little bit. So this right here is chapter 1. I'm recording this, so you'll be able to see this later. So I'm just going to page through all these pages, and you might be able to even pause the video and read the pages if you have time to do that. But in general, we're going to talk about different types of businesses that can be, the mechanism for creating a financial department. So that goes like sole proprietorship, a corporation, LLC, which is a limited liability corporation, company. And then there's a lot of other forms too, which are in this chapter. But the two main ones that you'll see are partnerships and LLCs. So partnership usually is law firms and consultants and entities like that. So when you're doing sole proprietorship, which means you own your own business, and partnerships, both of those are exposed to unlimited liability, meaning if you screw up, then you can lose everything and then some. So it's later on when you learn about financial risk mitigation, you're going to want to buy liability insurance so that if you do screw up, you're protected. But it's important to know that you can lose everything if you screw up as a sole proprietor or a partnership. So with corporation and limited liability companies, LLC, you can only lose up to the amount that you actually put in. So you're kind of off the hook in that way. So that's why it's a popular way to start a business, because you don't have unlimited liability. Let's see here. So businesses for a long time have been setting their goals to, we call it, increase the bottom line. And I'm sure you've heard that a lot in the business school already, but the bottom line is what you keep. So, revenue is what you make, and then you subtract the costs, and then you get to your profit. So profit is what you keep, and the bottom line is your profit. So there's different, like, stockholder wealth maximization and profit maximization. So we think about different avenues to get to different goals that you would set. So different types of companies set different goals based on what their needs are. So we have public companies and private companies. Public companies are traded on the stock market. Private companies are equity firms that don't have their shares for sale on the market. So that's an important distinction for the case study that we'll do later in the class. Excuse me. All right. So the value of the firm can be derived by what is your net cash flow over time and what's the rate of return on that cash flow. So that's why I mentioned the percents over a certain period of time in the beginning. In general, people are going to want their money sooner than later. And if they can't get it until later, they're going to want more because they have to wait. So that's where like interest is a good mechanism to fulfill that desire. So as a financial manager, you're just going to want to be able to look at all the available investment vehicles and choose the one that's going to have a net present value that's positive, that will increase your bottom line over time. So it's it's more difficult than it sounds when you're actually doing it in practice, but it can be easy once you develop relationships with the institutions that give the access to those interest rates to people that they know. So that's why I'd say it's good to know people that are in the business. So relationships are just as important as shopping for a good interest rate. And in general, the higher the rate, the more risk there is. And in chapter 5, we'll get into why that is, because you have to add in all of these risk premiums as time goes on. The bigger the period of time, the more risk there is that you'll actually get to that amount in the end. So there's government and business ethics, and the government will step in once there's some kind of major catastrophe or scandal that happens. And some good examples would be the Enron scandal, which led to companies having to report quarterly reports, which are the 10 Qs. And I think one of those problems will come up in the homework. But then also, like the Great Depression led to an act that, kind of limited what the banks could do. So there's a lot of different ways that government can intervene. But then there's also something called corporate governance. So that's the policies that the board of directors sets for the actual business to follow. So there's actual law that the government sets, the United States government, but then there's also policy that the business executives, the board of directors of the business set for the business. So there's kind of this two pronged influence coming from above. And then there's multinational corporations. So once you have a business that operates in more than one country, then you have to start you have to learn the rules of the other country to be able to operate in it. So the rules that are set here in America are different than the rules in England or other European countries or in Asia. So the bigger you get, the more rules that you have to learn how to follow. So it's really important to know how to not only create your financial reports to the needs of that particular country, but then be able to combine it all into uh, a financial report that would take into account all the different, like currency rates and different laws, and then submit it to the different you would call them um, exchange commissions. So the Securities Exchange Commission handles all of our reports here in the United States, and there are other entities like the SEC in other countries. So, some of the reasons why you'd want to set up multinational corporation is to seek new markets. So, different culture. Maybe they have a different need that you can fulfill because you have experience um, in that manufacturing process. Seek out raw materials. Raw materials are a big reason why companies move into to different countries, and that goes into like mining ore and timber and fish and um, like lithium for lithium ion batteries. Has to go through a process, and you usually find that in like salt flats. So there's very few areas in the world that actually have that. Seek out new technology. So countries have, America has a lead in technologies and in various sectors. So you know, companies come into like Panasonic, for example, is leasing out space in a Tesla factory because um, Tesla needed that battery technology. So they let Panasonic build the batteries in the Tesla factory. And then the Tesla people take the batteries and make it into a battery pack for their vehicles. Um, Production efficiencies. So that goes into like the economics class and comparative advantage and specialization. So, this is a lot of review from older classes. And then to avoid political and regulatory hurdles. So that's one of the main reasons multinational corporations exist, is to get around the rules of their home country. So a lot of corruption does take place, but we uh, exchange commission entities try to rein in that corruption by requiring reports to be submitted. And then, yeah, just it gets into like the financial aspects of it and how you use your government. I mean, the governmental roles of requiring the reports. There's a whole class that you could take on it, but just know that it's all in an effort to rein in corruption. All right, and then this is the problems from chapter 1, and in each module, so you'll see which problems I want you to do. It's always, each assignment is only 4 problems, so in total it'll be eight problems for tonight's mini lesson here. But I can go on. Oh, let me look at here, modules. And week 1 assignment. So number 1, number 5, number 15, and number 20. And you can just type it out into a Word document and email it to me. That'll be fine. Now, let's see here. So that's chapter 1. So it's pretty introductory stuff, just saying, hey, this is what we're doing. And this is the thought process you should have as we go forward. So just a quick review there. Financial decisions deal with cash flows, both inflows and outflows. All else equal, investors prefer more value rather than less value, to receive cash sooner rather than later, and less risk rather than more risk. The three principal forms of businesses are sole proprietorship, partnership, and corporation. The primary goal of a financial manager should be to maximize the value of the firm, which generally measures the firm's stock price. The managers of a firm are the decision-making agents of its owners. So this gets into corporate governance and what we call the agency problem, which means, do I serve the owners of the stock, or do I serve the managers of the company? And then there's lots of different ways to deal with that. All right, so firms that are ethical have a good governance policy, and then ethical just means it's open to interpretation, but means um, doing what is good for everybody, except instead of what's good for a group of people in the company. So that's kind of the gist that you should think about. So think about what's good for everybody when ethics comes up. Um, Firms go international for a variety of reasons. We covered that. Uh, Foreign firms are generally less open, and they have fewer owners than the U.S. And that's because they have different regulations and different exchange commission entities that handle corruption differently. All right, moving on, chapter 2, and this is pretty much a review of accounting. So I'll go through this kind of quickly. You have your financial reports. So you have your annual report, which is your 10K, and then your quarterly reports, which are your 10Q. And in those reports, you have your financial statements, which you learned about in accounting. And in the financial statements are your balance sheet, your let's see here, income statement, and your statement of cash flows. So I'm running through these pages real quick here. So the balance sheet, assets, liabilities, and then stockholder equity. The income statement goes into what comes in the door, what goes out the door. And then there's some examples here on the book that gives tables, and like common stock at par is equal to total shares issued times per share per value. So there will be a question in the homework about how to calculate common stock at par, and it is it's pretty easy. So I'll be available to help if you have any questions on that. And then the income statement, we covered that. And then the statement of cash flows is, it can help identify liquidity within a company. So, being a highly liquid company is good in a sense that in a monetary policy regime that has a low interest rate, like the one we're in now, being highly liquid is a benefit. But if the interest rates are higher, you're going to want to invest that cash into those into those high returns, so that you'll have a greater bottom line, like we were talking about before. All right, so we're going to get into some ratios after we talk about the statement of retained earnings, and that pretty much is if you're going to pay out a dividend or not. So you always you do your revenue minus your costs, you get your profit, and then you take your dividend out of your profit, and then it's called retained earnings is what you keep in addition to paying out dividends. So all that's documented in the retained earnings. And like right here, it says net income. Net income is the same thing as profit. All right. So then we go into this financial statement ratio analysis. So it's a bunch of ratios, which are, fractions, but each piece of the fraction you have to pull out of a financial statement. So I know you did a lot of these in accounting. So let's get right into it. Liquidity ratios are going to be what are liquid assets. Those are assets that can be converted into cash quickly. So what are those? We have our current ratio, which is your current assets divided by your current liabilities. And pretty much that means short term, like within a year's time. So that means, let's see if there's a example of anything here, like accounts payable, accounts receivable, 1 year notes, short-term payable or receivable notes, short-term creditors covered. So yeah, anything that's coming in within a year are liquid. Quick ratio is going to be current assets minus your inventory divided by current liabilities. So that's saying, okay, so inventory is going to take a little longer to turn into cash. If I were to take everything else that's in my current assets and divide it by my current liabilities, what's my position? All right. And then we go into asset management ratios. So this is going to be things like inventory turnover and something we call days sales outstanding, the DSO. That's saying on average, how long does it take to receive all of your receivable accounts? The fixed asset turnover, total asset turnover, and they're let's go over each one of those real quick. So inventory turnover is your cost of goods sold divided by your inventory. Days sales outstanding, your DSO, is your accounts receivable divided by your annual sales, divided by 360 days. We usually do 360 days because some people do 365, but there are major holidays that usually aren't counted in as sales days in a lot of different industries. So keep that part in mind. So that this is a really important ratio because it can go into whether or not you are getting the money that's owed to you, and if that number keeps on increasing, then people are slacking off on paying you back, and then you know that you have to hire a collections agency to help you with that problem. Fixed asset turnover is your sales. So sales and revenue are the same thing. So revenue divided by your net fixed assets. And that's going to be everything that is like property, plant, and equipment. So things that aren't variable assets, which are your receivables and your short-term receivable notes and things like that. Total asset turnover is sales divided by total assets. And then whenever you see sales, it's the same thing as revenue. And whenever you see net income, it's the same thing as profit. All right, we have debt management ratios, which is important because it goes into telling other people that are watching your business if you can pay your bills or not. So the debt ratio is total liabilities over total assets. Times interest earned, the TIE, is your earnings before interest and taxes divided by your interest. So sometimes you have to work backwards, like in one of the problems in the homework, you'll have to work it backwards. And it can be difficult when you're first trying these problems out. But just remember, from net income to EBIT, you have to figure out what the tax rate is. And then you have to figure out what your interest is. So it can be hard, but I'll be able to help you out if you need help on that one too. Fixed charge coverage ratio is the most complicated formula that you'll see in this chapter. It's your earnings before income and taxes, earnings before interest and taxes, which is EBIT, plus your lease payments divided by your interest plus lease payments plus sinking fund payments. So sinking fund is, you put a lump sum of money into the project so that you can lower the interest rate for everybody. So, but you have to pay taxes on that. So you have to divide that by 1 minus the tax rate. And why it says 1 minus the tax rate is because that's what you get to keep after you take the tax rate, the tax out. So 1 minus the tax is what you get to keep. The tax rate itself is what goes out the door. All right, so profitability ratios, we go into net profit margin, return on total assets, return on equity. And I know this is a lot of review, so it should be relatively easy per se, but not always. So net profit margin is your net profit over sales. Return on total assets is your net income divided by total assets. Your return on equity is net income divided by your common equity, which means market cap. And then, so moving into market value ratios, we have price over earnings, P over E. And that's a big determinant of stock price in today's environment, where we say we can guess where a certain industry is moving based on the average P over E ratios over time. So P over E is going to be your market price per share. So whatever price at that point in time on your stock market is, and then divide that by earnings per share. So earnings per share is your revenues divided by total amount of share. And then there's the market over book ratio, which is your market price again per share, and then the book value per share. So the book value is, a snapshot in time where your market price per share is fluctuating over time. So it's the market price will always be different than the book price, except for the time that the book price is written down, that exact point in time. All right, there's a couple more left here. So comparative ratios, you're going to want to be able to use these ratios that we're just covering here to be able to see if there's any trends that develop so that you'd be able to guess where a stock price is moving. And this is a big part of the game. Unless you are doing insider trading, which is illegal because you know what's going to happen, because you have inside information that people that would buy the stock don't have. This is how you play the game fairly. By doing a trend analysis, by comparing the ratios. And then there's something called the DuPont analysis, which is really a way to break down return on assets into, let's see here, ways to improve a firm's performance. So you really want to know where weaknesses are. So you use the DuPont formula to be able to identify gaps in efficiency and gaps in performance measures, which a lot of these ratios will be able to get you to. But then again, these are only as good as the next company. So you'll get the ratio number, but it's how you use it in your analysis that will benefit your company or not. So if you're looking for companies that have higher return on assets than return on equity, you're going to be wanting to compile a list of companies that do their business a certain way. So over time you'll know, like Google and Microsoft are definitely more ROE, so equity, versus Tesla, which is definitely return on asset, because so far Tesla's had a lot of trouble, making money profitably quarter after quarter since they've started. But there's a lot of upside because, electric vehicles are only 2% of the market right now. Okay. So remember, international accounting goes under the IFRS, which stands for the International Financial Reporting Standards. And then we have GAAP here in America. So just know that I think you already do know this, but in Europe there's less slack, so they have specific ways of doing it under IFRS, where under GAAP you have more discretion to create that slack that you would need, um, either through like inventory last in first out or first in last out. You have an option where in IFRS you have to do it a certain way. All right, so let me go back. That's the end of the chapter there, so we're almost done here. Thanks for. Let's see, chapter week 2 assignment. So week 2 is going to be number 1, number 2, number 4, number 6. And you can type that out on Word too, and then just email them to me. And don't worry about making it too wordy. You can just say this is what I think it is, and if there's a calculation required, then do your best on it, and I'll give you points for just attempting it. Okay, so then here's the rest of the problems here. And now I am gonna make sure that we get you onto I'm gonna upload this video onto YouTube, and then I'll send you the link to your email. All right, and then I'll also send you like a Word document that has the questions on it, so that you can just go right to the Word document to see which ones you have to do. All right, so thanks, man. Yeah, we're gonna do this. I got you. And we'll see how much we can get done before Tuesday, and I'll make sure that you get some points here for making an effort.
All right, thank you.
All right, Armani, have a good night.
You too.
All right, thanks, man. Oh.